Speaking of deals, you saw Churchill. We just brought that up. That was the second largest SPAC of all time in terms of what they raised, second only to Ackman's. Look at the move that has made. This is on that Bloomberg story from last week. It said they were reportedly in talks with Lucid. Remember, Lucid is that EV maker out of Saudi Arabia, really, or at least backed by the Saudis, making incredibly expensive cars. I went through them here. Of course, I can't find it, but you know, up to 150,000, if not more, in terms of their cost. They do charge more quickly. Very much unclear, though, at this point, whether they're going to reach a deal. That's kind of what I wanted to share here.
Hey, everyone, and welcome back to the Finance Zone. The implosion in Churchill Capital IV, New York Stock Exchange CCIV, has matched the speed and the ascent that preceded it. Following weeks of speculation, special purpose acquisition company Churchill Capital IV, CCIV, announced it will merge with the California-based Lucid Motors. Investors have been bullish on CCIV stock since the start of the year after rumors began flying about reverse merger. Support levels have caved just as resistance zones melted during its fiery flight. With prices now returning to a seemingly more sane level, many a spectator may be wondering if it's now time to take a bite of CCIV stock. Churchill Capital is a special purpose acquisition company, SPAC. SPACs are publicly traded companies that exist specifically to eventually merge with private companies that want to go public. In January, rumors surfaced that Churchill Capital will be merging with Lucid Motors, an automaker specializing in electric cars, and the company's share price began climbing rapidly. The shares jumped from $10 to a record high of $64.86 on February 18th. Now they are near $24. It is important to remember that Lucid Motors is still a pre-revenue auto group. Lucid CEO Peter Rawlinson recently said that orders for its first vehicle, the Lucid Air, have been overwhelming. Now, investors wonder what might be next for CCIV stock. Given the recent decline in price, the risk-return profile of the shares are better for buy-and-hold investors. If you're not a shareholder, you might regard upcoming dips in the share price as an opportunity to invest in this new company. What to expect from the merger? Lucid Motors is vying to become leader in the luxury electric vehicle EV market. Over the past year, TSLA stock is up about 300%. In general, EV market has been very hot. As a result, investors in CVIS stock have wondering if their new company could be a potential Tesla rival. The merger values Lucid Motors at $24 billion. It will also mean Lucid will have about $4.4 billion in cash, which in part can be used to expand manufacturing, Rawlinson said. Financing from the transaction will also be used to support expansion of manufacturing facility in Arizona, which is the first greenfield purpose-built EV manufacturing facility in North America and is already operational for pre-production builds of Lucid Air. With its projected range of over 500 miles on a single charge, ahead of all competitors on the market today. Often, the success of a black-check company depends on the management team. Churchill Capital CEO Michael Klein is a well-known Wall Street veteran. He has already completed several mergers. For instance, 2 years ago, Churchill announced a merger with Clarivate Analytics, a leading global provider of comprehensive intellectual property and scientific information, analytical tools, and services. In July 2020, Churchill Capital Corp. III struck an $11 billion deal with healthcare company Multiplan, MPLN, in one of the largest deals for a SPAC. So while CCIV stock has no operating business, the management team is experienced in the SPAC space to potentially make the next deal a success. Furthermore, Saudi Arabia's sovereign wealth fund is a strategic investor in Lucid. Therefore, the company has access to significant amounts of capital. Despite the frothy valuation of the company, investors are excited about the prospects. Now what? Churchill Capital and Lucid Motors will officially close their merger deal in the second quarter of this year. Investors appear to have calmed down a bit since the announcement, and Churchill Capital stock is down just 1% so far this month. But investors should keep in mind that SPAC deals can cause a lot of volatility and that more share price swings could happen. After all, the core reason for the optimism toward Lucid pre-merger largely exists post-merger. The search for the next Tesla long has struck me as a bit silly. Tesla had the noted advantage of not having an entrenched, established incumbent against which it had to compete. Lucid, Fisker, and others don't have that edge. But Lucid's car looks spectacular. It claims better range and better performance. It has its own skateboard platform, a la Canoe, GOEV, that can support launches of additional models. Again, Lucid itself was trying to highlight its discount to peers. But there should be some discount because Lucid isn't established yet. There's still a great deal of risk in the story relative certainly to Tesla. Meanwhile, all those peers have fallen as well. Tesla is down 27% in 2 weeks. FSR saw a big pop but has dropped 25% in 4 sessions. NIO and XPEV are down too. By Lucid's own methodology, CCIV should be cheaper. Signals and forecast. Volume is rising along with the price. This is considered to be a good technical signal. Some negative signals were issued as well, and these may have some influence on the near short-term development. The Churchill Capital Corp IV stock holds sell signals from both short and long-term moving averages, giving a more negative forecast for the stock. Also, there's a general sell signal from the relation between the two signals where the long-term average is above the short-term average. On corrections up, there will be some resistance from the lines at $25.41 and $31.19. A breakup above any of these levels will issue buy signals. A sell signal was issued from a pivot top point on Thursday, February 18, 2021, and so far it has fallen 57.86%. Further fall is indicated until a new bottom pivot has been found. Furthermore, there is currently a sell signal from the 3-month Moving Average Convergence Divergence, MACD. The stock has a golden star signal on Tuesday, November 3, 2020, in the medium-term chart. Why CCIV stock fell. There's been complaints that the company leaked incorrect information before the merger. Ostensibly, that it was to benefit PIPE, Private Investment in Public Equity, who invested alongside the SPAC merger at a price of $15 per share. Short sellers, as always in this market, have been blamed. But short interest was minimal, barely 2% of the float, and even some of that activity may have been hedges against owned warrants in CCIV stock. The actual cause doesn't require conspiracy theories or bad actors. Churchill Capital IV stock simply ran too far. The trading on Monday, February 22nd was particularly illogical. CCIV gained as much as 19% intraday and closed above $57, up 8.4%. Yet we had information suggesting that the rally was ludicrous. For instance, Bloomberg reported that weekend that a deal was near an evaluation of $15 billion. That followed earlier news from Reuters citing a $12 billion valuation. Yet at $57, Churchill itself had a market capitalization near $11 billion, and including warrants, its $3 billion plus in cash was being valued at a range of $16 billion. There was no way to support a price of $60 plus for CCIV stock given the information we had. And as the details of the merger were released after the close, the market rightly corrected the price. Bear in mind that according to Churchill itself, there will be 1.6 billion shares outstanding after the merger. That figure doesn't include some shares and warrants which vest in coming years. And so the $64 peak of CCIV stock valued Lucid Motors at a stunning $102 billion. The $57.37 close on the 22nd valued it at more than $90 billion. Once that became clear, CCIV plunged. Bottom line on CCIV stock. It's too soon to know how the share price of CCIV stock will move in the coming quarters. Lucid is still a startup automotive company with exciting prospects. A successful merger could be the start of a very appealing investment, one that many will keep their eyes on, but large amounts of capital and time are required before significant revenue will be made. While betting on a resurgence has low odds at this point, I could be convinced of cash flow trade like selling puts. The appeal is simple. Forsake direction, embrace cash flow. Given the interest of the street in EVs, as well as the background of the two companies, I believe the merger will create shareholder value in the long run. However, potential investors should still carefully study the risk-return profile of investing in the company at this point. First, CCIV stock is hovering near $20, making the margin requirement, aka collateral, for a naked put low. That translates into a high return on investment. Second, unless you think prices will retrace 100% of their ascent by returning to $10, buyers should emerge at some point between here and there to create a tradable bottoming in the stock. The beauty of selling puts is it creates a wide profit range. CCIV stock price can rise, stagnate, or fall, just not too far, from its current level, and you still win. There's also the added benefit of potentially buying shares at a steep discount if assigned. If you want to wait for confirmation, consider using a break of a prior day's high to signal the current downswing found a bottom. The price is working on its 6th day in a row with a lower high. Your max gain is $1 per contract and will be captured if the stock sits above $17.50 at expiration. If it's below that level, you will be obligated to buy 100 shares at a cost basis of $16.50. Remember to check the description and use my WebBull referral code for 2 free stocks.